For decades, Wall Street banks controlled the financial rules in Washington. If they opposed a bill, it died. If they wanted a loophole, they got it. But in the spring of 2026, that historical dominance hit a wall. On May 14th, the Senate Banking Committee voted 15-9 to advance the Digital Asset Market Clarity Act. Despite a coordinated pressure campaign from every major banking lobby, 2 Democrats joined a unified Republican bloc to pass the bill. Lawmakers were responding to 2 specific pressures ahead of the midterms. 67 million Americans now held digital assets, and the crypto industry had built a $200 million super PAC to influence the coming election cycle. The banks were fighting to keep their deposit base, the essential funding source for their entire business model, from draining into digital wallets. The Clarity Act builds a new legal framework for the industry. It defines decentralized network tokens as commodities, moving them into the same regulatory category as gold or crude oil. This definition removes these assets from the SEC's reach. After years of the agency using lawsuits to control the market, the Clarity Act strips away their enforcement authority over these tokens. By placing oversight under the Commodity Futures Trading Commission, the industry secured explicit legal boundaries required for banks and hedge funds to enter the market. The most aggressive part of this legislative battle is fought over a single mechanism: stablecoin yields. Traditional banks multiply checking deposits into local loans. The Genius Act blocked stablecoin interest to protect this. Now, the Tillis-Alterbrooks Compromise in the Clarity Act allows crypto platforms to offer rewards with equivalent economic value. If customers move their cash from local banks to yield-bearing digital wallets, the banks lose their lending capacity. Industry analysts expect this to shrink local lending by $850 billion. Banking associations have publicly attacked this deal. They argue the language allows crypto firms to offer high-yield products without following the strict capital and safety rules required of traditional banks. Stablecoins have moved beyond their original use as trading tools. They are now functioning as a direct alternative to the American savings account. This legislative push coincides with high-level regulatory moves for World Liberty Financial. This crypto firm, tied to President Trump and his family, is currently seeking a federal bank trust charter. Opponents in the Senate, led by Elizabeth Warren, have called this an ethical crisis. They argue that granting a bank charter to the president's family company creates a massive financial conflict of interest. The crypto lobby's influence now reaches into the highest levels of the executive branch, ensuring that regulatory approvals and legislation move in their favor. By defeating the banking lobby, the crypto industry secured a permanent place on the Wall Street floor. That victory came with a specific price, found in Title III of the bill. To stay in the system, every digital asset firm must now integrate directly into federal anti-money laundering and surveillance networks. Cryptocurrency began as an attempt to build a financial system outside of government control, rooted in absolute privacy. The Clarity Act ends that era. Digital asset firms traded their autonomy for a seat at the table. They secured the protections of a regulated institution, but only by agreeing to wear the permanent handcuffs of the federal surveillance state.